Welcome to The Explainer. Today, we're pulling back the curtain on one of the most powerful, yet invisible roles in all of finance, the underwriter. Yet, they're the person who's basically the gatekeeper for all your biggest financial moves. You know that feeling, right? You apply for a mortgage or a car loan, you hit submit, and then you just wait. It's kind of nerve-wracking. But have you ever stopped to think about who is actually on the other side of that screen making the call? That person is the unseen gatekeeper. They literally stand between you and that loan or that insurance policy you need. Their yes or no can change everything. So what is underwriting exactly? Well, at its heart, it's all about one thing: risk. It's the super detailed process that banks and lenders use to figure out if loaning you money is a good bet. Think of it as their financial defense system. They're deciding whether to accept the risk of lending to you and, just as importantly, what price or interest rate to charge for taking on that risk. Okay, so how do they actually make this huge decision? It's not just a random guess or a gut feeling. Underwriters rely on a classic, time-tested framework. You'll hear it called the 3 Cs. And those 3 Cs are capacity, credit, and collateral. These three things are like the holy trinity of risk assessment. Let's break down exactly what each one means. All right, first up is capacity. This is the big one. Can you actually afford to pay this loan back? The underwriter is going to dig into your income, check out your job stability, and crunch the numbers on your debt-to-income ratio. They're trying to answer a simple question: will this new monthly payment break your budget? Then you've got credit. Think of this as your financial report card. Your credit score, your history of payments, it all tells a story about how you've handled borrowing money in the past. And for a lender, past behavior is one of the best predictors of future performance. And the last C is collateral. This is basically the lender's safety net. If you're getting a mortgage, the house itself is the collateral. It means if everything goes wrong and you can't pay, the lender can take the house to get their money back. And that's exactly why a property appraisal is always required. They need to know what that safety net is actually worth. Okay, so that's how it works for you and me buying a house. But what about underwriting a massive skyscraper or huge apartment complex? The basic idea is the same. It's all about risk. But the way they look at it changes in a big way. See, when you're dealing with commercial real estate, the focus shifts from the borrower to the property. The lender doesn't really care about your personal salary. They care about one thing and one thing only. Can this building make enough money on its own to pay the mortgage? The property is the business. And to figure that out, they look at a key number called net operating income, or NOI for short. You can think of NOI as the raw, pure profit the building spits out before you even think about paying the mortgage. So, how do they calculate it? It's actually pretty straightforward. You start with all the rent you could possibly collect in a year. Then you've got to be realistic, so you subtract some money for when apartments are empty, and then you subtract all the costs of running the place. We're talking taxes, insurance, repairs, you name it. Whatever's left over at the end, that's your NOI. Okay, so once you have that magic NOI number, you can run the final test. I like to call it the ultimate pass/fail grade for a commercial loan. It's called the debt service coverage ratio, or DSCR. And what it does is simple. It tells you how many times over the property's profit can cover its yearly mortgage payments. So, going back to our example, this property has a DSCR of 1.31. What that means is it makes enough money to pay its mortgage 1.31 times. That's a pretty good cushion, right? Most lenders want to see a number of at least 1.20. That buffer shows them that even if rents dip a little or expenses go up, the property can still make its payments without going into default. So these rules, the 3 Cs, NOI, DSCR, they're the bedrock of sound lending. They're fundamental. But what happens when the gatekeepers just stop doing their job? What happens when these rules get thrown out the window on a massive global scale? Well, you get 2008. Now, this didn't just happen overnight. It was a slow burn. In the early 2000s, super low interest rates lit a fire under the housing market. It became a frenzy. Speculation was everywhere, home prices just kept going up and up until they couldn't anymore. The bubble popped, and a tidal wave of mortgage defaults started to rip through the entire global financial system. So what went so wrong? A huge part of the problem was this model called originate to distribute. Here's how it worked. Banks were making loans, but they had no intention of keeping them. They were just flipping them, selling them off almost immediately. And when you do that, guess what happens to the 3 Cs? They go right out the window. Suddenly, lenders didn't care if you could actually repay the loan. This is where we got the infamous ninja loans. No income, no job, no assets. The whole game was about pumping out as many loans as possible because, hey, the risk wasn't going to be their problem. And this is the scary part. This is how a local problem went global. A single high-risk loan made in, say, Florida would get packaged up with thousands of other loans. This bundle was turned into a fancy financial product called a mortgage-backed security, or MBS. Then, and this is wild, rating agencies would often stamp a safe AAA rating on it. And finally, these securities were sold off to pension funds and investors all over the world who thought they were buying something super safe, but were actually buying a box full of toxic hidden risk. And just look at the scale of this thing, it's just staggering. In just the 2 years leading up to the crash, the amount of these risky private label securities just exploded. It completely dwarfed the number of mortgages coming from the more traditional, safer sources. The entire financial system was just flooded with bad bets. Okay, so fast forward to today. In the years since the crisis, technology has completely changed the game. And now, this ancient practice of underwriting is staring down its biggest change ever: the rise of the machines, artificial intelligence. So you have this classic matchup, human versus AI. On one hand, the AI systems are incredibly fast and consistent. They can crunch through applications at lightning speed, and they apply the same rules every single time, no exceptions. But they can't see the gray areas. They lack that human touch, that ability to understand the unique story or context behind the numbers. And this move to AI brings a whole new set of problems to the table. For one, if the data we feed the AI is biased, well, the AI is just going to learn and repeat those same biases. Then there's the black box problem. If an AI denies your loan and nobody can explain exactly why, is that fair? It creates this risk that we just start blindly trusting the machine's decisions. And that's exactly why regulators are pushing so hard for something called explainable AI, or XAI. The idea is simple. The machine has to be able to show its work. So, it's not really about AI replacing human underwriters, at least not completely. It's more about the job itself evolving. The underwriter of the future probably won't be spending their days buried in paperwork. Instead, they'll be more like a strategist, overseeing these complex AI systems and stepping in to apply that critical human judgment when the machine gets it wrong. And that brings us to the big final question, doesn't it? We're building these incredible automated systems that promise a safer, more efficient financial world. But what if we're just building a faster, more efficient way to make the same old mistakes? Is all this technology just building a superhighway to the next financial crisis?